already briefed you on the idea yet. But I just add on to it by saying that we have 6 startups, 3 of them are intrapreneurs. They're all within Boeing, and 3 are the particular external startups. These are the startups run by founders, and so. We really look forward to this conversation actually, to how to raise capital and pitch to VCs. This is the most favorite discussion any startup can have. So looking forward to an interesting conversation. If you have any questions to me, people join in. We can talk about that.
Okay, yeah, great. Right now, it looks like there's about a dozen folks online, so we can give them a minute or so, and then we can kick it off.
Sure. So let's kick it off, Mike, because that's the number of participants that we have. So thanks for coming in, spending time with us. And we will skip the introduction of every person who is on the call because there's definitely kind of loose down doing so. But as I said, 3 startups, 3 internal and 3 external. And what we will do, we kick off with a brief, 5 minutes, 10 minutes, what we say, high level pitch on how do we do that in general, how to raise capital, how to pitch to VCs, given that we are all early stage. That is where you can focus for this conversation. And then we'll open it up for an interactive discussion, wherein people will ask questions based on their experience and their specific context. And that's how we will spend this next 1 hour. I hope that format is okay with you.
Yeah, that's fine. And I know it's getting late in the evening over there, so I appreciate everybody's time. And happy to kick it off. And then, like Sanjay said, let's have a Q&A so I can answer any questions. My name is Michael Lohner. I'm investing director at Horizon X Ventures, which is the corporate venture fund for the Boeing company. I'm sure you already know about the rest of Horizon X, so I won't bore you with that. What I wanted to do was one, and again, recognizing I'm giving a bit of perspective from the U.S. side, so I know India is going to be different, but hopefully this helps. And I know with our communication lines being halfway around the world, there may be some choppiness on the phone and whatnot. So let's just bear with each other and have a good discussion. So let's just talk a little bit around first raising funds from VCs. Everybody hears about all of the stories about founders walking into a coffee shop and running into a venture capitalist and getting a $5 million check and they become billionaires. Those are, I'll say, hyperbole and anecdotes. It seldom happens that way. It's a lot of work to raise money. You hear stories all the time. So outside of Horizon X, I also do some angel investing, and we'll have companies come in 3 or 4 times to pitch the angel group over the course of a couple of years, and they don't get funding. And you hear stories all the time of startups saying, I talked to 50 venture capitalists before I got my first little check, and it's driven by a lot of timing. A lot of the venture capital funds have sort of defined life funds. So they raise their first fund, let's say $100, $200 million, and then they're expecting to invest that over really, let's call it 5 or 6 years. And then the rest of it, they're really just doing follow-on investments. So the way you want to think about it is, if they've raised $100 million, they're really only going to invest about $50 million of that in any given group of companies. because they're leaving the other half of that, or the dry powder, to follow-on investments for those companies when they do additional raises later on. So that's why you really want to focus on venture capitalists that have raised their fund recently, because then they have dry powder that they can actually invest in new companies and new ideas, rather than sitting on money waiting to invest that in follow-on rounds of their existing portfolio companies. So, if you're going into a venture capitalist that has a fund that is nearing its end of its life, let's say, it's been around for 7 or 8 years and they haven't raised a new fund yet, it's going to be very hard to get money out of them, because the way it works is the limited partners who invested in that fund, they're expecting to get their money out in 8 to 10 years. And if it's already in the 8th year of the fund, they're not going to invest that money because they know they're not going to get it out in time to exit their fund. Because as I'm sure you know, generally the life of a lot, and it's gotten a lot longer before an exit event. But typically, from a very early stage, let's say angel investment type size company, to where there's an exitable event is 6 to 8 years. So when an investor is investing in a company really early, it's almost a marriage, that you're going to be there for 5, 6, 7, 8 years with that company before you have the opportunity to potentially get your money back. So that's the mindset that folks are going into when they're thinking about that. Is how long is my money going to be tied up, and what is the likelihood of me being able to pull it back out with an exit? And the exit can either be, well, we've read in the news a lot of how IPOs are getting less and less, and now it's big funds like SoftBank coming in and providing ways for the early investors to get some of their money out. So more of the private transaction market versus going an IPO. But again, that's in the back of every investor's mind, is how am I actually going to get my money out of this thing when it's all said and done? The other thing you want to focus on with VCs is be very specific about what sector you're looking at. So most VCs over here have some sectors that they're very close to. Don't go into a VC just because they've got a big name, because they may not actually be investing in the sector you're in, and you're basically wasting everybody's time, yours and theirs, by doing it. So if a particular company, if you look through their portfolio and they're really known for medical devices, don't go in there and think that they're going to fund a check for an aerospace type product. And so if you can really carve and narrow down the type of VCs you're looking at and do a lot of research, it'll save your time and their time. So I don't know. I'll stop there for a minute and see if there's any initial questions.
Anyone on the call? No, not doesn't seem to be. So while you spoke about this usage to do, also what do we tell the children? Can you elaborate, like you did? Can you elaborate, on what should go into a pitch, and then what kind of questions typically come up from the VC when a pitching conversation takes place?
I'm sorry to catch all that. Could you repeat some of it?
Oh, okay. So I was asking that if you can put throw some light on what goes into a great pitch that is given to investors by the startup.
Yeah. So on the pitching side, so the first thing you need to have is an elevator pitch, and that's not a slide deck, that's not a cue card, that's nothing. You just need to have your story crystal clear so that you can talk to somebody about it in 30 seconds. And the term elevator pitch sort of came by. If you're stuck in an elevator with a venture capitalist and you started into small talk, could you explain your business and the value added and why somebody should invest in it in 30 seconds or less? So with that mindset, when you're thinking about your business plan and presenting it, that's the mindset you need to have, is you will only have a limited window to talk about something. So it needs to be crystal clear around the value proposition, the size of the market, and how far you're along in that business and evolution and maturity. Now, once you get to a pitch, here in the States, they generally the VCs will carve out a day or two a week where they invite certain companies to come in and do a pitch. And your first pitch may only be a half an hour to an hour. So again, you want to think about the voiceover. Now, what's happened over the last few years is the pitch has sort of evolved a bit. It was much more, I'll call sort of a typical strategy deck where there's a lot of data and value chains and things like that. It's getting much more to graphics and voicing over. Now, it depends on the VC you get into. Some of them will look past that real quick and start digging in deep on some of the questions. And again, this goes to what venture capitalists, you may have introduced yourself to. If they are really knowledgeable in the space, they will dig really quick into some certain things. And you got to realize the value that a VC has is, while your business may be unique, the VC's seen 20 other businesses that are comparable or sort of go after the same market or got some of the similar technology. So they've got this whole perspective of the market that you as a single company coming into the meeting may not have. So they will ask all kinds of questions based upon other interactions with other companies. So as you're thinking about going into the pitch, you need to think in the back of your mind, you need to take all of your market knowledge and think about what other technologies have you seen out there. And if they ask the question, how would you tell them that you are different or similar? If you've seen a market, different sizes of the market sizing, for example, you might say, well, for example, McKinsey has said this, but XYZ has said that. We feel that the market's more in this area and give reasons why. And that actually conveys to the VC that you're more of a thought leader. You're not just following market studies that somebody else has done. And then a big thing you got to think about too is your pipeline. So every venture capitalist or angel investor is going to want to see your pipeline and understand how you build up that pipeline. One thing I like to see on pipelines is, so in the aerospace industry, we call it P-go and P-win. And P stands for probability. So,
can you repeat that? Yeah. Sorry, Michael, we lost you. Can you repeat what goes onto the pipeline?
Yeah, so pipeline is your initial customers. So customers you've been talking to, and how you back and stack those by the likelihood of them being a paying customer is where P-go and P-win come. So P-go is the probability that that customer is going to have a budget to be able to pay for something. So especially in aerospace, budgets are 12-month cycles, 18-month cycles. The first, and even large companies, it's not consumer-based where people just put on their credit card and say, oh, I don't have budget, but I'm going to put on my credit card. So in corporations, they've got the budget. And so you need to first have a line item in that budget to buy your product. So that's P-go. So you may be talking to your potential customer and they go, yeah, it's probably 50-50 that I'll be able to get a line item in my budget this year. So your P-go would be 50%. And then P-win is after the budget is in there, what's your probability of winning that budget? So there may be 3 other competitors going in to go after that budget line. So at a high level, you have a 33% chance of winning that. So the P-win would be 33%. Now, when you multiply the two together, you get somewhere around 16%, right? So at the end of the pipeline for the revenue number, it wouldn't be $100, it would be $16. So that's how you risk your pipeline to show that, hey, I have a potential for $100 here, but after I risk adjust that, it may not get a budget in the budget line in the budget, and I adjust it for competition, it's only going to be about $16 potentially. So by having that really provides some realism to your numbers. And any investor will appreciate that, because the first thing they will do, and we call it the hockey stick, right? They'll see hockey sticks, and they will mentally just start knocking down the hockey stick. Well, if you've already done it for them, that gives you more confidence in front of them that, oh, these guys know what they're talking about. They are, insightful about their pipeline. They see where the revenue is going to come from. And if they decide to invest in you and they have some contact with these companies, they can help increase those probabilities by making some phone calls on your behalf.
Mm-hmm. That's interesting. The concept of ego and seeing probability. That's a very realistic way to assess where we stand with respect to getting the fund. So we have three external startups here. They will be, I'm sure, significantly interested in. So,
I don't know if you're too close to the mic or something, but it's awful muffled. I can't pick up much what you're saying.
Hello.
Yeah, that's better.
Hey, I lost Hey, Amit, you have any questions? Were you asking something?
I was just saying, your mic was a little close to your mouth or something. You were awful muffled.
Okay, sorry about that. I think that there are three startups on the call. These are extra. They are very keen, looking for funding, etc. Amit, Vikshuk, and Vaishali, why don't you, if you have any questions, why don't you raise them? Good time to, get some first-hand knowledge out of the VC himself.
Right. Thank you so much, Sanjay.
Go on, Vishali.
Sorry. Brilliant. So, Michael, thank you so much for your time and those words of wisdom. I think a lot of that was amazing insight. I actually have a quick question around how investors look at numbers. So, for example, I mean, if you're pre-revenue or maybe even early stage, everything is a projection, everything is hypothetical. So how important is it to show, where you could be 5 years later, what the valuation will be, and all of that, since it's all, for want of better words, just a load of bullshit. How relevant is it really, and how much do investors weigh in on that?
Yeah, that's a good insight. So, folks that come from a heavy M&A background, they're used to discounted cash flows and deep diving into financials and things like that. But in reality, early stage investing, like you said, the numbers are wrong as soon as you enter them into Excel, right? They are just fundamentally wrong. So basically, a detailed financial analysis is used to sorry about that, is used to sort of validate that the team has thought about the market and really understands. For example, if I see in a financial model that they're assuming 10 employees, but sort of industry metric is they need 50 employees to be doing this, that immediately tells me that they haven't thought about their market or they don't understand their industry, right? So I use the financial model more so to test assumptions. And there's a valuation methodology called the Chicago method. And basically what it does is it says, take whatever the financial model is and run scenarios against it and say that the probability of being above that baseline number is maybe 10%, but in reality, they're going to be 90% below the baseline. So you do some weighting on that baseline assumption, and they apply discounts to it depending on where it is sort of in maturity, and it comes up with a valuation. So that's one way to help come up with a valuation, but in reality, so much of the valuation is art on early stage. And the more sophisticated investors that have done a lot in the market, they sort of have a mental model where similar companies are asking for funds. I can give one example over here. So the company is called Desktop Metals, and they're an additive manufacturing company or a startup, and they had a ridiculous valuation, and they had a lot of big strategics throw money at them. It was a one-time event. It was a fluke. But all the other additive manufacturing companies started to try to base their valuation on that one data point, and nobody was raising money. Nobody was raising money. So we are now having some of these additive manufacturing companies coming back at a third of where they thought their initial valuation was, because they realized they just could not raise money where they thought the market was, when it really wasn't there. And again, that's going to sort of understanding where the market is. So here in the States, typically a angel investment where you might be looking for, let's call it $100,000 to $500,000. The valuation might be, so this is pre-money, might be $2 million to $5 million, depending on the management team, depending on the market it's going after. So that's sort of the ballpark for an angel investment. And then typically what ends up happening is, this is again a rule of thumb, but for every time you raise a dollar amount, you're going to have to give up somewhere between 20 and 30% of the company. So if you want $1 million, you're going to have to give up 20 to 30% of the company. So that's sort of how you back into what the valuation needs to be. But again, to your point, the financials most of the time are used more for seeing if the management team actually understands the market and can think through the true costs. Because again, in the VC's mind, they want to know what the burn rate is. So they'll look at that to help understand what the burn rate is over the short term. But from a valuation perspective, it's a guidepost, but it's not heavily used as far as, oh, I came up with an NPV of $50 million, therefore my company's worth $50 million. By the time you layer in all of the risks, and you just can't say, well, it's going to be a 30% discount rate or 40% discount rate, because early stage investors want 100% returns, 80% returns. So it really gets whacked down a lot for sort of the C, Series A, Series B. And then once you get to CD, so you've already evaluated the market, you're already making a lot of money in the company, then you can start using pro formas to help value the company, because you have much better insights, to your point, of what the pipeline looks like and what you can actually sell stuff for and what your costs actually are. So I'll say the early stage is much more of an art than a science when it comes to valuation.
Brilliant. Thank you so much. I have a couple of follow-on questions that I'll ask maybe later to give other people the chance to ask questions too. If there's time, I'll ask them. Thank you.
Sure.
Typically, what is the size to go for a VC round of investment from a value perspective?
So it depends on what stage you're in. So I mentioned, for example, an angel round. Now it depends on, it's the hot market again. It could be bigger. What if you find a super angel that really wants to cut $1 million check? That may happen as well. But most of the angel groups, which is where I think most of your businesses would sort of fall in, are sort of So an angel here in the state typically writes a check, let's say $25,000 to $100,000. And they'll get a few of their friends involved, and so that's where you're sort of looking at a check size or an investment of somewhere between $100,000 and $500,000, sort of as your non-family and friends first raise. Now, you're raising a good point of where. So I talked a little bit about sort of the fund life, like when you want to get into them, but then there's also different classes of VCs. So over the last 5 years, there's what's called micro VCs or early stage VCs. They're focused on sort of that institutional seed or early Series A investment. They're generally smaller funds, so they may have $50 million portfolio, maybe $100 million portfolio, but they're writing checks sort of the $500,000 to $1.5 million range. That's sort of their sweet spot. Because again, going back to my analogy, if they're a $50 million fund and half of it's going to be used for follow-on investments, they have $25 million to invest in companies, in new companies, and if they're writing an average of $1 million check, they've got 25 companies in their portfolio. That's sort of about the right number, 20 to 25 in their portfolio. So that's sort of what they're focused on. And once you get into sort of the A round, what you're running into is to really to move the numbers on their fund. They need to be cutting multi-million-dollar checks. So that's why the big funds, a lot of the big funds won't even look at you unless you're asking for at least $10 million. Because it's just not worth their time. It doesn't move the needle on their fund if they've got a $500 million fund or $1 billion fund, right? That's part of the reason why SoftBank just writes these huge checks, because they've just got such a big fund. Writing $1 million check does nothing to their fund, and it just creates an administrative nightmare for them. So once you get sort of in the A world, I'm actually coaching one of my companies through this now, is they didn't want to be diluted down. So they were like, I just want to raise $1 million or $2 million, and that's it. But they couldn't get any traction. And I said, well, that's because no VC is going to write a check for $1 million or $2 million. It's not big enough for them. I said, you've got to increase your ask to $5 to $6 million, and then you can get one or two venture capitalists to cut a check for $2 or $3 million each. And then you're starting to open up your aperture to more VCs that you could possibly pitch to. So, I know from a founder's perspective, you don't want to be diluted. You don't want to be diluted. Or in this guy's perspective, he said, I just don't need that much money yet. Well, you got to think long term and say, you got to find the sweet spot for the VCs. You've got to be able to justify why you're asking them that amount of money. And, typically you want 12 to 18 months of runway because you don't want to be out there raising constantly, even though you are. So I hope that was helpful.
Yes, it was helpful. Basically, a follow-up question is, what is the duration a VC will look like for, let's say, to be stay invested, and what will be his exit, let's say, target number of valuation, let's say if somebody is writing a check of 2 to 5 billion?
Yeah, sure. So, that's sort of a loaded question. It depends on the investor. It depends on what round you're in. Like I alluded to, a early stage investor, sort of the number in their head is a 10x. Everybody's saying I'm looking for a 10x. If they can get a 20x, and so when I say 10 or 20x, that's a cash-on-cash return. So if they invested $1 million at exit, they want $10 million or they want $20 million. Probably most of what ends up generally happening is you have 3 or 4 investments that might get 20, 30, 40x their money. You have a few investments that might get 10x. You have a majority at sort of the 3 to 5x, and then you've got about a third of your portfolio just loses money completely. So when it's all said and done, people are probably at the 3 to 5x. But the goal is always to pitch a 10x. Like, how can I get an investor a 10x return? That's what their mental model over here sort of is a 10x. So as an exit, if you can show that that $1 million investment is going to be $10 million in 5 years, and you can do the math. There's actually charts out there that say, okay, if you return X number of dollars, sort of cash on cash over X time frame, what does the IRR end up being? And that 10X over 5 to 7 years ends up being about a 30 to 50% IRR. Which, given the risk profile of potentially losing all your money on the deal, is probably about right. So I would say, if you can pitch to a VC that they're going to get 10x their money back in 5 years, that's a place to start.
And how accurate should be the TAM, SOM, and SAM numbers from a study perspective?
Yeah. So, a lot of folks just take numbers that they find on the internet or some consulting reports done by McKinsey or Booz or any of those guys. And so I've worked with enough of them to know how they build their models, and they build them just like you do. They sort of take the current year, because you can sort of find the current year or the prior year. And those are going to be pretty good. And then you start extrapolating that based on growth rates, right? How fast do you think certain segments of the market are going to grow? So it's around that. It's really talking through the assumptions. And if you can say, hey, I started my TAM or my SAM or whatnot it's really the TAM we'll be focused on right now. I started based on last year's numbers. These are firm numbers. They were put out by the government. We know these numbers for sure, and then these are sort of the range of growth rates I've applied to them, because McKinsey says it should be 5% a year for the next 10 years. The government agency says it should be 3% for the next 6 years, and so I think it's somewhere in here. So that gets you sort of your 5 and early stage. Past 5 years, you're really guessing. So I'd like to see sort of 5 year numbers. Even though the 10 years is helpful just to say, hey, where do you think the market might go or could potentially go? But what I really focus on out of that is, the SAM and the SOM. It's really how much do you think you can capture of the market. If your numbers are based upon that you're only capturing 3% of the market, 5% of the market, that is a completely different discussion than if somebody comes in and says, oh, I'm capturing 80% of the market. That person's going to sort of be laughed out of the room, right? So that is sort of the level of fidelity you want to see in sort of the TAM, SAM, SOMs, all of that is understanding how you're going to grow into the market and what percentage of the market you might capture. And then also using that to identify what segments in the market you're going after. So one of the visuals I like to see is a Mary Mecco, the Mecco chart. Because with that one slide, that one chart, it's really a two-dimensional pie chart. You can really say, okay, here are the market segments I'm going after and the customers in each segment, and you can say, use it to discuss your beachhead. You can say, well, I'm going after this sub-segment of the market because it's of this size, it has this characteristic, et cetera. And then you can use with arrows and say, okay, now I'm going to jump over into this market segment and this customer of that segment because it has these characteristics that are advantageous for my business. So, it helps to show the size of the market you're going after and what segments within the market. So it can be a really nice way to talk about it. Unfortunately, not a lot of people know Mecco charts. So if you're in a room with somebody that doesn't understand them, you're in trouble. So you really got to know your audience when you're talking with some of the more sophisticated visualization methods.
Thank you.
Any other questions? 4 minutes left.
Yeah. I was asking Viksit, do you have any questions?
Sorry, I didn't catch all that. There was some honking in the background.
I was asking Viksit from Booby Air if he had any questions. Viksit, are you on the call?
Can you hear me?
Yes.
Fantastic. Hi, Mike. This is Vic here. some fantastic insights that we've got. Thank you so much. I had a question about, when VCs look at early stage startups, what kind of traction, early traction are they looking at, looking at B2B startups, we are at a stage where we are building an MVP and we hope this MVP kind of implemented and having users start using them. At what stage would you recommend, in terms of early traction, that we start looking at raising funds through the VC route?
So typically, you're not. The likelihood of you having actually sales is probably small. But if you can do a proof of concept where somebody, a business is paid for cost or at least reimbursed you for a little bit, that is probably, having one or two of those with different customers is always helpful. For example, here at Boeing, we may have a startup that we've spent a couple months doing a proof of concept with. Okay, under what conditions would your product be applicable to what we're doing? And we test those out. Having that type of stuff, so while you may not have a true pipeline of revenue, if you have a pipeline of proof of concepts or somebody that is reimbursing your costs to do a proof of concept, those are sort of the early triggers for a seed round or even a Series A round. Generally, the way to think about rounds is, seed is prototype and initial proof of concept. A is you've done your proof of concept, you have some working prototypes, and you start to engage the customers. And then when you go to a B raise, that's really about you nailed all of that, and now it's about scaling. So you're looking for money to really scale that initial beachhead. So if you think of it in sort of those terms, if you're sort of at that seed early A round, you want to have proof of concepts, you want to have working prototypes, something that the investor can sort of put their hands on and touch and feel and understand. And depending on the VC, they will see through vaporware real quickly. I've looked at companies where I had some of my subject matter experts look at it, and they sort of came back to me and said, yeah, so a couple of grad students with a couple boxes of pizza could have done this thing in a weekend, right? That is not something that's going to get you a $5 or $6 million valuation. So it's what is that unique IP that you can bring to the table as far as a proof of concept to say, hey, this is something that's really differentiated and can add a lot of value. So I hope that was helpful.
Michael, I had a question around investment in foreign companies. So, from an American standpoint, how interested are investors in looking at a company that's not American? And if they are willing to kind of come in, say, start in the US, how does that work? As in, how are investors looking at that? And I'll give you a little bit of context. The reason I ask is, so we have an augmented and virtual reality company, and what we are trying to do is democratize access to these technologies. So we built a platform with which a non-coder can create their own augmented and virtual reality experiences. The problem with the Indian scenario is we're still trying to evangelize the use cases of AR/VR in industrial processes. So to be able to go to the next step and tell them, we have something which your existing personnel can use, is proving to be a little difficult. We're still working on it, but ideally, if we have to look at the US as as where we want to be, or where we expect that we could really start taking this product anywhere, even before we reach any concept of scaling. How interested or how much of a useful step would that be to either move there or to stay an Indian company from the investor perspective?
Yeah, so I think it's VC specific. So, for example, Sequoia, they've got a huge operation here in the U.S. They also have one in China, but China operates through most of Asia, and they're I'll say they're sort of they're siblings, but they act independently, right? So for somebody like Sequoia China, you don't need to be in the U.S., right? But for somebody that has their only U.S. based, it's advantageous. But what I tell all the startups is just coming to the U.S., while it opens up Silicon Valley is a unique experience. I mean, it's really a phenomenon. And it provides a lot of opportunities, but there's also a lot of competition. So I know some companies that will just hire one person, and they'll get a WeWorks office or something like that, just so that they have a location or somebody in a hot area, like the Valley, so that they can start going to some of the networking events, they can start talking to the VCs, they can talk to sort of people that are of that mindset. But recognize that there's that whole infrastructure in their home country that they need to leverage from a cost perspective, or just a capability perspective, or a network perspective, because you know a bunch of folks that are sort of doing it in that market. So it cuts both ways. You hear stories all the time of companies lifting their whole operation and moving it to the U.S. And then they don't find money, and so everybody's sort of like, well, why did I just pick up and leave when I had a nice little thing going back in my home country? So I would say a baby step, if you determine that's the way to go, is to find a person in the U.S. to hire them and have them be the satellite office, and just recognize there's going to be a lot of traveling done initially to try to get some of the Valley VCs at least get on their radar screen. Now, with investing internationally, that has its own issues. So here in the U.S., we have some very, I don't want to call them templates, but they're legal documents that like everybody uses. So from my perspective, when I'm looking through these documents, I immediately have a flavor for what each of the sections is asking, where there's going to be pushback, where there's not going to be pushback, what the legal ramifications are for all these sections. But for example, I led the deal that we just did in Australia, and completely different set of documents and considerations and things. So I was on a steep learning curve. I had to hire in-country legal expertise. And then there's just other nuances that I didn't quite appreciate. So, Boeing's a global company, so we're used to doing that. But there are a lot of VCs that just don't want to deal with that. So, by staying in a foreign country, if you're looking at expanding the investor base, that could hold you back.
Okay, makes sense. Thank you. And if we have time, Sanjay, do we have time? Michael, do you have time for another question?
Yeah, we have 15 minutes.
Okay, great. So another question in terms of, say a scenario after the investment. Where are, at whatever stage this is, and considering this is all going towards growth and getting customers, where are investors comfortable with seeing how you're spending the money? Do they expect, all of it to be going into marketing? Are they okay with a lot of it going into, kind of securing the tech you already have? Or making it better, or is that a complete no-no? I mean, the reason I ask is because a lot of people we've met here in India, the minute we tell them that, we have the tech, we have the, IP and all of that, but there are still some things that we need to do, and of course it's a constant process, but there are things that we need to do to make it, ABC better. And we faced a lot of flack where they're like, yeah, but we don't want to give you money to improve your tech. So how is that really addressed or looked at?
That's interesting. So, typically if you're in a seed or a Series A, you're not going to be doing much marketing. I mean, you're not going to be hiring a marketing staff. You're going to have somebody going out there. It's usually the CEOs out there talking to people, trying to get proof of concepts and things like that. But really, that funding is to get the technology nailed down. Really, when you start hiring a lot of salespeople, is late Series A, early Series B, typically. I can see where people want. If you already have a lot of the tech, people want to get you out in the market, and they want you to focus more on the marketing stuff. But the last thing you want, so you only have one bite at the apple, right? And my take on it is, you want to get the tech 80% right, 90% right before you start engaging a bunch of people. Recognizing that you don't want to build your tech in a silo. So that's where the proof of concepts come in, is you do a proof of concept to evolve your tech to meet where your customer need is. And I would focus personally on that. I can see why you're getting a lot of pushback saying, I don't want to spend money to improve your tech. But you always need to be improving your tech. So if you already have something that's sort of proof of concept, I would allocate some of your budget to marketing and some of it to without knowing specifics, to the R&D, and just say, hey, we need to stay at the cutting edge of where things are. Our tech is not, 70-80% there, but we still need to invest in it. But we recognize we're going to need to invest in marketing and do proof of concept and get those things going. So that'd sort of be my recommendation without knowing too much more.
Okay, makes sense. Thank you so much.
Sure.
Thanks, Kelly. I mean, we still have some time. I just wanted to, I haven't really asked the internal startups, to come forward and ask, but because this discussion is, quite more relevant to the external startups. But drone aggregator team or UL or guys, if you have any questions, why don't you come forward, ask those questions now?
One quick question, Amit here, Mike. So, from a milestone perspective for raising a fund, let's say at a Series A kind of from Valley, can you also give us some kind of idea of what are the typical success milestones to make sure it is going in the right direction?
Yeah, so for Series A, again, it's having your tech ready so that somebody can kick the tires and play with it. And the other big one is proof of concepts. So good proof of concepts where you have your party you're working with willing to sort of give you a recommendation. And then understanding your pricing and cost. So you've done a couple proof of concepts. You should sort of know where your pricing is, because that's key. You don't want to just do, it cost me $100, so I'm going to do a 30% markup, so it's a $130 price. You really want to understand what your value pricing is, and then understand what the true costs are. There have been companies where they needed to hire more marketing people and salespeople than anybody ever imagined. And sales and marketing people with their commissions and everything gets expensive really quickly. So, when you're going to your A, having some of those sort of insights is critical to getting a good valuation and getting money. Because again, from our mindset, the riskier and the more unknowns, the less the valuation is going to be. So, we see companies all the time where they went out and raised a lot of money with a lot of risk. Well, the VCs took 50% of the company for that risk. So now you've lost 50% of your company, and you've got to raise more and more money. So, before you know it, the founders are diluted down to 20% ownership, 15% ownership. Well, at that point, that bothers me because I want the owners to be incentivized, right? So when I see deals like that, I actually lean to walking away from them because I'm like, well, everybody's got to be diluted so far down, all the existing investors, to incentivize the founders and the employees, that it just makes the numbers hard to close. So that's why I'm a firm believer when you go out to raise them, they have a lot of your key risks sort of have a path to knock them down or knock them down before you go out and raise your money.
And do VCs see single founder a risk for raising capital?
Sorry, I didn't catch that.
Does VC finds a single sole founder in a startup as risk?
Yeah, so they don't mind. There's a single founder. That's not. If I answer your question right, that's not a big issue. The one thing that it does raise though is ongoing IP, and make sure that if that founder gets hit by a bus, unfortunately, can the company go on? And so VC is going to want to see that there's been information sharing, that there is a succession planning, that if it's code, that I've seen deals where the code was escrowed, and given to the source code was given to an attorney. And the attorney doesn't share it with anybody unless something happens to the couple of the key founders that knew all the source code. Or if the company goes bankrupt. For example, I've seen this too, where a large strategic bought a license to the IP, and they were going to invest a lot of their own money to implement it. And they were concerned that this whole startup would go bankrupt. So to help alleviate that, the startup said, fine, we're not going to give you the source code because we're still a business, but we will escrow the source code with an attorney. And if the company goes bankrupt, you will get access to the source code so you can do improvements on it, et cetera. So, having a sole founder is not an issue, just as long as you have mechanisms out there to address that.
Great, thank you.
All right. Any questions from the internal startups, the entrepreneurs? So we are now coming to the end of this session. No. Any more questions from you? If not, then I have a question, Mike. I'll go back to the pitch again. Because see that happens to be the starting point, and how do we make, we heard that there needs to be an elevator pitch, and there could be a follow-up 30-minute to 60-minute discussion, what should generally go in it. But what are the key, what is considered as a strong pitch? What are the characteristics of a strong pitch? Something that the investors take back home.
I didn't catch the last part. What investors?
What are considered as the strong characteristics of a pitch? And what are the key messages that investors typically take back with them?
Oh, sure, yeah. So what are the key messages of the pitch and what needs to go across? Typically what I like to see is no more than 10 slides, and especially from a very early stage, most of it is gut feel about the management team. Can the management team really get this done? Do they have the network to get it done? Do they have the technical chops to get it done? Do they work well together? Do they have good personalities? It's very much a relationship thing because you're invested, like I said it before, it's a marriage. So is this somebody you want to be married with for 5, 6, 7, 8 years? So it's really about the management team. So that's one of the key takeaways. 2 is whether or not you really understand your market and where it's going, the size of the market, the opportunity set. And then for a lot of VCs, it's looking at the macro, generational, cultural shifts. So if you think about the companies that have become unicorns, right? What happened with them? They found a seismic shift in culture or receptivity to things that have sort of changed the mindset. Now, there's been a lot of companies that have been very successful as V2 companies, right? Where like Uber kicked something off, did it, and now there are companies worth more than them. They're doing it in India, in China, et cetera. So having those sort of things in the back of your mind as you're pitching to the VCs, because that's what they're taking away. They're taking away that first gut feeling, what they the management team, the market size, sort of macro shifts in the market. Can this really be something that grows with the market?
Mm-hmm. Excellent. Okay. So these are again, these are all the messages that we want to think that once we, and when we stand in front of the VCs or the angels, whoever, that these are the conversations. One last question, 2 minutes to go. How do we, is there a difference between seed and angel investment? How does it pan out? What would the angel look for, that is different from the seed investor?
What's the difference between what?
Angel and seed. Angel investors and seed investors.
Oh, yeah, so differences between investors. The seed investor, I would say, has a much higher risk profile. They're going to write smaller checks, though. And a lot of the seed investors will want to be very hands-on. A lot of seed investors are former executives that are really wealthy and they retired. And they're like, you know what, I still want to have some fun and work with some of these startups. So when you're thinking about a seed investor, think somebody you really want to work with, because more likely they are going to be calling you at least once or twice a week. And that's another thing to be careful of too. So there are investors out there that they don't want to let their money go, and when they do, they want to know it's being taken care of, so they'll call you a lot. So the question is whether or not you want that person investing in you, because you're going to spend a lot of your time talking to these people, telling them what you're doing. So you want to find the right mix that recognize that they're there to help you and leverage that. Leverage those people's networks, their insights, their expertise. But you also want to recognize that some of them are going to be trouble investors, and it may not be worth their money.
Mm-hmm. Okay, understood. All right, Michael, we are just out of time now, and there are no more questions. If there are questions, we'll take the liberty to reach out to you over email. And if you have too many questions, we'll take the liberty to set up another follow-up call. I hope that will be okay with you when we schedule this properly.
Yeah, it was a pleasure chatting with everybody, and I know it's a little late over there, and appreciate the chat, and don't hesitate to aggregate some additional questions. After you've thought about it a little bit, there's a couple follow-ons. Happy to provide a little perspective. So thank you, everybody. Appreciate it, and talk to you later.
Talk to you soon. Bye.
Thank you.
Hello?
Hello?
Yeah.
You don't know who this is?
How did you... What number is this?
What number are you getting the call from?
Some random weird shit number 918241194. What numbers? How many numbers do you have?
This is my Geo number, weirdo, so you never saved my numbers.
Both your numbers. It's not showing.
This is the Geo number.
That's really good.
So this was quite interesting, huh?
This is an awesome call. He has so many to say. I wish I attended the first part of Justin's call.
So I took notes for the first part, and it really wasn't. It was just an introduction.
Okay, sorry, 1 second. I have